Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Friday, June 1st. God, can't believe it's June. Edition of Benzinga's PreMarket Prep. Spencer Israel, as always, joined by Joel Elconin and Dennis Dick on the show today. It's going to be a jam-packed show. We have a lot of news and two guests. So our guest will be at 8:15. First up is Ryan Craver. He's one of our retail experts, the senior vice president at the Lamour Group. And then at 8:35, we have Tracey Ryniec from Zacks joining the show. But in between those guests, before and after, we have to talk about today's jobs number. Of course, we have to talk about some earning stocks that we had after the bell yesterday. We want to talk about the continuing action. I guess Dennis and us are enemies now with tariffs. So we're going to talk about the reaction to that in the market yesterday. So we have a jam-packed show. We'll squeeze as much of it in as we can. Let's start with the S&Ps. Joel, where are we?
Oh, we're green on the screen, up 12.75 already, ahead of the number 27.18 a quarter, right near your pre-market high 19.75. Let's keep an eye on yesterday's high, that Globex high at 28 and a quarter. On the downside, really, pre-market low is 06 even. That's right near the close from yesterday. So we pretty much been straight up since the open. We have Bitcoin in the red by $170 at 73.85, and crude's fallen into the 66 handle, down 53 cents at 66.51. Gold down 570, 12.99, and silver in the red by a nickel at 16.40. Dennis, how you doing this morning?
I'm doing pretty good. Sad story about the tariffs there, Spencer.
Yeah, what's going on, man? You guys
aren't
are
happy about
frisky
this.
over there.
I don't think we can do the show anymore, honestly. It seems like
us Canadians are so unhappy about this. So I don't even know what to say. I guess we're not going to be trade partners anymore.
Is Trump going to put a tariff on our show that we can't do it anymore?
Don't give them ideas, Joel. You're live. We're going to give them ideas here. I won't be able to broadcast from Canada anymore into the U.S. Because that, it's just we don't want Canadian content on the show.
Did you see his tweet this morning? Did you see his tweet this morning?
What's the tweet?
Tell him the tweet, Spencer.
I didn't see the tweet this morning.
You didn't see the?
What's the tweet? Tell me the tweet.
I don't look at every single tweet.
Suspense is killing me.
Looking forward to see the employment numbers at 8:30 this morning.
Who said that?
Donald Trump.
Nice.
Yeah.
Anyways, it's tariffs, whatever. It is what it is. Justin Trudeau didn't sound too impressed with his press conference yesterday talking about it, obviously, but it is what it is, and obviously they were going to put big tariffs on China, and then that didn't happen. So talk is talk still. We don't know what's going to obviously transpire here at the end result, but not that good for Canada if we start getting tariffs on.
Trump said he's looking forward to the number. Hasn't he already seen the number?
He doesn't know the numbers?
No.
No comment.
He would have already seen it. That's interesting.
Yeah, they're in the chat. They say White House officials are typically given access.
Yeah, he would have
to monthly employment data the day before the reports are.
So there's that a tip off that it's going to be really, really good?
I mean,
did we just get tipped off that the unemployment number is going to be awesome?
I think we did.
I think we did too. Okay, well, what does that mean? We got 25 minutes. Chat, what does that mean? The unemployment numbers are awesome. So does that mean rates can go higher?
Oh yeah, we'll take a while to
figure. Good for the economy. Right? Are we back to this market that no matter what, it's good for the markets? Because obviously sometimes you get it's too hot of a number. Okay, well if it's too hot, then they're going to raise rates. Oh, the numbers, not that great. So I don't know. Anyways, the interpretation of these numbers, you sometimes need you sometimes they can ignore all your background from your finance courses and your economic courses, because sometimes these interpretation of these numbers are just impossible to figure out.
So the consensus estimate is for 189,000 jobs. That's the non-farm number, and unemployment staying steady at 3.9%, which was last month's reading also. So safe to assume we're going to blow those numbers away. Maybe we're going to have 200,000 jobs and unemployment at 3.8%. I don't know. I mean,
Very interesting. I mean, those are all-time lows. So, obviously, the numbers speak for themselves. Economy's still booming. What does this mean for the S&Ps? Because we are still in a trading range here for the last basically 3 weeks. We look for the majority of May. If we look at the SPY chart, we've been between like 268 and 274. I had a little dump there 3 days ago where it started to look like we might break down, but right back up above it. We held support yesterday, Joel. We're up here again, 272. The Deutsche Bank fears are out of the woods for now. Deutsche Bank ride a little bit there yesterday. I don't think we're completely out of the woods, but at least today, this morning, Deutsche Bank is actually trading higher here, and the banks are looking higher, and the TLT is trading down. So you got to think banks are going to be strong here. Unemployment data can change everything about that, though.
It's all about breaking over 27, 41, 75. You had two highs in May, right at that area. May 14th, you hit 41 and a quarter. And then on the 23rd, 41.75, a couple other highs at 39 and a quarter. So 27.40, close above that would confirm another leg higher. On the downside, I mean, we had that one blip on Tuesday down to 26.75 where, you just had to close your eyes and buy. I mean, that was bought up right away. And yesterday's low was 26.99.75. So we've been in that 40-point range here all the way since, for the majority of the month. So whether you break down below that 2,400 level or break out above 27.40. Pretty simple math on those numbers.
Let's jump. We got 8 minutes before our first guest, Ryan Craver, and we're going to talk retail stocks with Ryan. So maybe we'll save some of those for him. But there's a lot of other stocks to talk about from last night. We had some interesting reports there. A lot of them are retailers. Go to the couple tech stocks that reported. VMware first, up 5 points here. Spencer, results for VMW.
Q1 EPS $1.26 versus $1.15 estimate. Sales $2.008 billion versus $1.96 billion. So a beat on both the Q1 numbers. They raised their EPS outlook on the conference call to $6. Their fiscal year EPS outlook to $6.14 versus a $6.01 estimate. They also raised their sales outlook to $8.87 billion. Again, this is the fiscal year sales. 8.87 versus $8.73 billion was the estimate there. So increase guidance for the fiscal year, and they beat on the top and the bottom line for the Q1 quarter number.
So is this like officially like not going private ever again? Because remember back at the beginning of the year when you saw VMware taking off and it was rumors that Michael Dell was going to take this one off the board too and bring it back private. Stock got up to $165 and then obviously collapsed a few days later. So I'm assuming that isn't happening. Now it looks like it's trading on its own fundamental information here once again. So can we officially say that it doesn't look like this is going private? 3 months later, 4 months later.
Whatever happened to that spread?
Oh man, the DVMT really blew out there for a while. So VMW. So if you look here and you can bring up DVMT, which is Dell Technologies, it's actually just a tracking stock for VMware, but it doesn't track that well because when all these rumors were happening at the beginning of the year and it was going to be that VMware was going to potentially go private. And we didn't know what they were going to do with the tracking stock. Was the tracking stock then going to stay public, going to track a private company? Was DVMT going, shareholders of that going to kind of get, screwed over again, for lack of a better word, like they did last time? There was a lot of concern there. So you saw VMware going straight up and DVMT going straight down. And normally these two stocks follow each other very closely because DVMT is just a tracking stock for VMware. Now it's kind of tracking again now. So if you look and you bring up the two charts on each other, they look very similar, but they're not tracking perfectly. And you really spooked out a lot of ARB traders. I used to play that ARB all the time. After that happened, I completely stopped playing the ARB because there was so many unknowns. That spread in the one day blew out 25%. That is an epic collapse for risk arbitrage traders because risk arbitrage guys are going in this thing for 0.5%, 1%. When it blows out like 25 or 30% one day, that's an epic event for risk arbitrage. That is like big time trouble. So I got lucky that I didn't get killed in that one. I actually had it on that day, and I was like, this is all unknown stuff, and I took it off. I took a small loss. I believe I lost about 1%, one of the best 1% losers you can lose, because it ended up blowing out like 25 or 30. So you got, even on the risk arbitrage and even on the arbitrage stuff, you still got to know when to cut out, because sometimes funny things happen when there's fundamental information potentially changing a spread. That's when you got to say, if you're a risk arb guy, I got to get the hell out and wait till this digests and understand the news better.
And the spread kept on going, right? And that one,
it blew out big time, man. It blew out. I can remember, if you go back, you can look. It was early in the year, so we're looking in January.
Yep.
And if you look at the candles from, let's say, go into that January. Well, I got to go to the dailies here. You can look January 26th, I think it is, when you see VMware blast off in orbit. So January 26th, VMware goes from $139 the day before up to $165. Normally, DVMT would follow suit, but it did not. It went the other way. And DVMT opened up that day, killing anybody who was playing the ARB, because everybody thought, oh, it's opening too low for VMW. And then it collapsed that day down to $76. So you're losing, if you had the ARB on, you're losing like 18 points on the DVMT, and you're also losing about 30 points in the worst case scenario on the VMware. You're losing like 50 points right there. That in one day, it's unheard of in risk arbitrage land. That's like, when a deal blows out, or a deal, and risk arbitrage for the most part is usually done with, this. So I'm using risk arbitrage. You almost got to say this is just like straight up arbitrage, because they're arbing, from the tracking stock over. Risk arbitrage is involved usually in mergers, but it's kind of like a risk arbitrage play more, because there's still a tracking stock involved and it's not perfectly tracked. So that's why I'll use the term risk arbitrage on this. But DVMT down 20, VMware up 30, 50 points lost for your risk arbs out there. Man, that blowout accounts in a hurry.
And how is it now compared to that day? It kept on going.
So okay, so let's look back. So we're basically at the same price we were. It's funny you asked that, because 142, that was the day we were kind of in January. If you look at DVMT, we were trading slightly down from there. So even if you held it through all this pain, you'd be down about $10 on the DVMT and about flat on the VMware. So you still haven't got the money back if you were holding through all this. Plus, you're paying fees probably. I don't know how easy the DVMT became to borrow. I know it became tough there for a while. And that's the other, consideration when you're doing sometimes, share class arbitrage, like, with Viacom and VIAB. Remember, I've always traded that close too. Well, for about a week and a half in there, VIA became hard to borrow, or almost impossible to find the borrow on the street. And VIA had buy-ins happening where it was shooting up. So despite VIAB, which is their main stock, not moving, VIA was going straight up, and everybody's like, what the hell's going on? That's called a borrow issue. When you can't find the stock to borrow, all your arbitrage traders have that on doing the share class arbitrage, can't find the locates. If your broker can't find the locate, they will physically go in and buy in the stock in your account. So, people don't realize that the broker can do that, but they legally have to. If they cannot locate the stock, they got to be in compliance with SEC regulations. They will physically go in and buy the stock back in your account, and nothing you can do about it. It's called a buy-in. Usually they give you a warning. Usually, I know IB will give you a 10-minute warning. If you're getting bought in at the end of the day at 4 o'clock, they'll warn you at 3:50 and say, this stock is, subject to buy-in here at the end of the day. And if you don't buy it by by the end of 4 o'clock, we're going to buy it for you.
Okay. All right. Let's just take a real quick look at VMware. Trading in the green here by almost $5. Not a lot of volume is traded in this. Just let me give you your pre-market high is 143 even. We've hit that on a couple different brackets. Dennis mentioned that 142.29 high. If you're looking for more resistance above that, the high, the all-time high in this is 145.15. So see if it has the gas to get there. All right, Dennis, we managed to get 2 stocks in 15 minutes. Now we got
but it's okay. It's okay though.
My arbitrage talk.
No, it's okay, because we're going to cover all the retail stocks.
I just want to tell you, Dennis, after he got out of that trade, he called me. He was out of breath. He was literally.
I couldn't believe that blew out that much. I was like, I can't believe I only lost $1 on it. And I was like, that's the best buck I've ever lost.
And you said, and you traded, I don't know if you remember, you traded it a third of that size that day because you.
I know, because it would look fun. Like this news was out. We're going on the tangent again. It was out, and I was like, I don't know really how to interpret that. And I had the spread on. I was like, I need to get the hell out of this, because I don't know how this is going to be interpreted. If this VMware goes off the board, what if they leave the DVMT public? And now I'm tracking a private company. Well, how the hell do you do that?
I don't know.
All
All right, 8:15. We're going to take a quick break and let's grab Ryan Craver from the Lamour Group. Welcome back, everyone. Pre-Market Prep, Spencer Israel, Joel Elconin, Dennis Dick with you on now with Ryan Craver, Senior Vice President at the Lamour Group. Ryan, how goes it this morning?
Good morning, gentlemen. Some big earnings last night from people like Lululemon. Go retail.
All right, let's go right into the Lululemon report here, and unbelievable, man. I looked at the stock ahead of the report, and boom, adding another 770 here, up at 112.72, blowing away the all-time high. Is this warranted here at these levels?
I was shocked by the numbers. The numbers were incredible. I think it's probably got some more room to run. I would put a tight stop on it, though. Some of the low-hanging fruit within the industry they've stolen, and they've done a great job of keeping margins. They've done a great job of managing inventory, and they've done all that without a rudder. It's a ship without a rudder. They have no CEO, and they're still looking for a CEO. So fantastic numbers. I think it's still got room to run.
I'll just read the number real fast. Q1 EPS 55 cents versus a 46-cent estimate. Sales 649 for $615 million. Comps up 8% for the quarter. Again, they raised their outlook for the fiscal year. EPS and sales both raised. That'll do it. So great number from Lulu. What else jumped out to you?
Well,
Ryan?
did they give anything on the online sales? How are they doing online?
I'm
sure they said something. Ryan, I don't know if did you know about that?
They did. I don't have the number right in front of me. I can pull it. But it was very, very strong. I think what we're seeing with Lulu is more and more of the business is coming from their brick and mortar than it was previously. So you're seeing margin improvement. If you think about them before, they didn't have nearly as many stores as what they've got now. And it was very strong. It looks like 8 comp, and then direct to consumer net revenue, which includes the store, increased 62%.
All right, let's you sent us over a really nice looking chart here, and I'm going to have Spencer pull it up and just go over this with you. I assume this is like your own design here. This is something that you came up with. Yep, at Ryan M. Craver joining us here. Tell us about this chart, like the thoughts behind it and implications for the future.
Yeah, so I like to use this every quarterly earnings to update myself and understand where the market share is trending, at least as a percentage of everyone's wallet and where they spend. And it leads you to understand which sectors are doing better than others. I think the big takeaways for me is if you look at that first group, that group is called off price, and that's the Burlingtons, the Rosses, the TJ Maxxes of the world that predominantly sell off of manufactured suggested retail prices 30, 40, 50% down. What surprised me here is the consistent improvement in sales. So Burlington posted a 4.8 comp, fantastic in this world right now. Ross, which I think is not getting enough love, and it hasn't seen a stock price appreciation based upon the number, posted a 3 increase. And then TJ Maxx, strong business internationally, strong business in the home business, strong business in their core domestic business. They posted a 4 comp, and we've seen their stock benefit from that. Nordstrom Rack is typically one that does a lot better and they were able to eke out a small gain. So they haven't seen any improvement. You move into the dollar stores. I think the dollar stores have seen some pretty bad trades lately. If you look at Dollar General and Dollar Tree, just in the last couple of days, I think they might be a falling knife that you may want to try and catch.
Yeah, I mean, let me interrupt you here for a second because you know, I from the chart here was, you know, looks like the Q1 same store sales weren't that bad. I mean, they're in the green here. I mean, what was it that they didn't like about those reports, and why do you think it might be a falling knife you may want to catch?
Yeah, so they were not bad at all. I mean, if you look at Dollar Tree and Dollar General, you've got a 2.1 and a 1.4 comp increase respectively. I think what's happening here is there's a lot more love for the off-price sector. So that group that we mentioned before, everyone was shocked by those numbers is the first reason. Second reason is you have some more premium players like Ollie's, OLLI, that are showing much bigger growth rates that are kind of playing in the $1+ to $5 range. So they're getting a lot of love. And then the third thing is, I think with all of the stores, the dollar stores slowing and how many stores they're opening, a lot of people are wary of the fact that they believe there might be some saturation of dollar stores in the U.S. I tend to agree there are too many, and they're going to continue to slow their growth rate. With that said, you can't be surprised, or you have to be surprised by the fact that they've dropped 9% and 14% last couple of days. They're going to get to some points where Dollar General specifically, if you see it stop around the 85 level, I would pick some up and put a tight stop on it. This is well overdone in my opinion.
Okay, what about now explain Macy's to me here? You know, they're the same source sales in the red, but they like the numbers. Is this a sustainable trend in Macy's?
So I have always, probably since we started speaking, been pessimistic on the department stores and said if you had to ever play any department store, play Nordstrom or Kohl's. I still am not a believer in Macy's. I think what we saw was some very crafty moves by Macy's. They pulled one of their marketing events from the second quarter into the first quarter. So they bumped their comp sale. If you truly look at where the comp sale was up, it was only up 1.7% if they wouldn't have pulled that marketing event in. I think there's still more pain ahead. I do think they have changed the narrative on Wall Street. So the belief is that they're investing more in tech, they're closing more stores. But I still think that there's more pain there. If I was you, I would take your gains if you're in it,
okay,
and not go long term on this one.
All right, let's move over to Sears here. And boy, oh boy, how long can this company remain an ongoing concern? I mean, staggering losses, debt. I mean, I don't even know what property they own and what it's worth here. Boy, oh boy, how long can Sears stick around?
Yeah, it's a good point. I think they are working with the remaining crumbs that they have. So taking Craftsman's Kenmore, tying up with Amazon on a few initiatives. I think that, they're doing what they can. I think it's obviously not a long-term investment that I would play. In fact, I should probably even take it off this chart because it's really screwing up the scale of the reporting. I would steer clear.
All right, let me ask you.
Wait, can I interrupt 1 second?
Sure,
Ryan, can you just explain real quickly for those who don't know what this chart is measuring comps? Can you explain what that is?
Yeah, so this is in my opinion, the best way of understanding if they were to compare the previous year's sales on the same store base to this year's sales. So are they generating more sales out of a store year over year? And that's a good way of understanding whether they're improving their overall operations of the store and the product that they're selling.
And so it's only for stores, obviously, that have been around for more than a year. So do they factor in new stores the year after, correct? Those get factored in the following year.
Correct.
Okay.
Yep. So the two numbers that they usually report are going to be a net sales increase, which would assume new store openings are in that number.
Right.
And then if it's a comp sales, it's not assuming the new store sales. I think it's easy to juice the top line if you've got new stores opening, but it's a lot tougher if you're not.
All right, I want to ask you about an issue that I'm in here and didn't have the greatest report, but price action is okay. Tell me about LB, L Brands.
This one, I mean, I can't say any good things about any of their brand holdings. With that said, you know, it's gone through the misery index, and you know, if you think that there's a longer term plan, there might be some relief. I'm not a fan of the plan that they have put in place, the long term plan for what they believe they're going to do to turn around the overall company. So I personally would be a wait and see guy.
All right, how about Tiffany's? Did that move catch you off guard? I guess the high end here. Spinners mentioning Lulu and Tiffany's and Movado. Talk about the Tiffany numbers, and is this a sustainable price trend and also a trend in earnings beats?
Tiffany, amazing numbers, and I would agree with Spinner. Definitely on the high end, I think we're seeing some very strong names, and that's why Nordstrom not being or doing much better than the slightly positive comp surprised me. I think in terms of Tiffany, I think it's run a little bit too far, in my opinion. I think that the run was justified, so maybe it trades sideways for a while.
Okay, I just got to ask you here. I don't know, see if Dennis has any for you, but I really was curious to see what you think about Amazon here. Obviously, if you look at the stock price here, everything's perfect in Amazon land here. And, we do have the jobs number coming up here in a minute. Just that you're not really hear much about that transition with the Whole Foods and stuff. They're cutting prices here. Any chink in the armor in Amazon, and then we'll let you go.
I think Amazon's still incredible. All of our numbers, all of our brands that we sell on Amazon, that is where the majority of the growth is. You look at what they're driving in terms of online market share. They've now got 28%. That's up from 20% roughly 6 years ago. I think it continues. I think it's going to break through that 800 billion market cap. And I think there's still maybe a chance it gives Apple a run for the $1 trillion company.
All right. We've been joined by Ryan Craver, Senior Vice President at the Lamour Group, and one of our favorite retail experts to have on the show. Ryan, thanks so much for your time today. Have a good weekend.
You too, guys.
All right.
Joel, let's bring it back to the
here
S&Ps.
we go. We got the SPOOs here, and we're trading up 13.5 handles at 27.19. Got a little preview from a tweet from El Presidente here that there are going to be some good numbers here. Banks are trading up 30. Well, I see Bank of America up 36 cents here. Hot number, that means higher interest rates. That, should be good for the banks. A bad number, well, they probably get hit. They usually move the most off these numbers. We are hanging out right 3 ticks high off the high of the session, which is 1975. And Spencer's going to break in here in just a few
30 seconds just about until we get the number again. I'll repeat what we're looking for. 3.9% unemployment and 189,000 new jobs and non-farm payrolls is the two numbers that we're looking for.
Breaking news here. Yesterday's high, if you're looking for a potential resistance points, 27.28 and a quarter. What's going on here? May jobs report. SPOOs are not reacting yet. Getting a little hit here. Just tick down to 17. Hot number, right?
It was a big one. Yep, it was a big one. Let's get Brent just yelled. Brent, what do you got for us? 223 is the non-farm number. Holy cow! I guess 200. So 223 versus 189,000 in the non-farm payroll, and unemployment down 3.8%. 3.8, 3.9 was the reading last month, and the estimate 3.8 is the reading for May. What's happening, Joel?
The SPOOs, they're backing off just a tad here, but I mean, they're finding buyers so far here. Since that number came out, we did have a quick print down to 1575, but like every print here, let's see what happens. We're at 1650, 16 and a quarter. Trying to hold up. I mean, we're really going nowhere. I mean, before the print, we were trading at 19 even. We're trading within 2.5 points of that. Banks, which were already in the green, are continuing to move, but not that much. Bank of America up to 39 cents at 29.43. Let's just see how that compares with yesterday's range in Bank of America. Boom. Gold's getting hit on this, so I guess they're not too worried about the number. Yesterday's high in Bank America was 29.26. We're trading above that. 2-day high, 29.60. So far we've moved a total of 2 points, and we are just locked here.
Crickets.
Yeah. What did anything
Crickets.
move?
I was actually just getting all prepped for it in the background there. And there's really nothing here. I mean, a 2-point move. We're back to muted response to economic numbers, I guess.
Or is it the fact
we went through this for the longest time, and then, early February, March, April, we were really whipsawing on these numbers. Now it looks like it's crickets.
Is it that, or did Trump's tweet just kind of take the wind out of it?
Maybe they already knew. Like Trump's tweet, everybody, we were already traded up, and we were already there because of that, maybe. But this is, we've moved a point. Hot number.
Yeah, but if it's that great of a number here, and then we're looking at inflation, they're whacking gold here, Dennis. Gold's not getting any kind of bounce on this. I guess the Fed.
TLT's getting hit a little bit too. TLT was in the red. I think a little bit to what Spencer was saying when Trump came out, then saying that we knew the number was probably going to be hot, and it looks like the overall market did too, because the trade was kind of already on. Banks were already strong. TLT was already weak. And now we're just seeing, a little bit continuation of that move. I mean, TLT has fallen another 20, 30 cents since the number came out, and banks have gotten a little bit stronger there. Bank of America trading up near 29.50 here now. But, overall here, bonds, bad for bonds, obviously. And it looks to be still good for stocks, although stocks are trying to leak a bit.
Okay. All right. Do you want to try and get any other reports in here before our 8:30?
Well, did we talk Abercrombie and Fitch?
No. And did you see that thing get hit yesterday, Spencer?
Really hard on the guess numbers.
Yeah. Oh, that's it. Okay.
Guess got annihilated. GES, opened up flat, and they just hit that thing all day long. And then, they hit Abercrombie too, because they're like, oh, if you're going to hit Guess, you're going to hit Abercrombie. Abercrombie's bouncing back this morning. So a little bounce back, but what I will say is you're going to run it overhead supply here now. You had an ugly head and shoulders pattern that obviously broke down yesterday. Now you get back up to that area on an okay number here. I think you're going to find some sellers here potentially in Abercrombie and Fitch up near this 25 area. What's the number, Spencer, and what's the pre-market?
Good numbers. Q1 EPS 56-cent loss, 77-cent loss was the estimate, so they beat that by a nice amount. Sales $730.899 million versus $696 million estimate, so beat there as well. Fiscal year 18 sales and comps up between 2 to 4%. Q1 comps were up 5%.
Nice comps, nice number. Just the fact that you got that 25 to 26 so traded for so long in there, that's why it gets thick up there again, because there's a lot of people who will have, purchased it or sold it from those prices, and that's where you'll run into trouble again here. What's the pre-market high, Joel?
Let me give you the pre-market.
Don't tell me 26. I'm bang my head against the wall.
I don't want to bang your head against the wall there. It got it through there by quite a bit. I don't know if that
above
was
26.
Yeah. Well, this is
I gotta fade these things.
26.50.
Wow, so much overhead supply. So that's the big difference. When the chart's open and it's breaking out to new highs, it's
Nothing
wide
there.
open and things continue to go. But when they run into previous highs from the last month and a half, you've been just fighting in that area, it gets back up there. Everybody has a chance to get their money back, so they're quick to hit the sell button. So you have everybody trying to get out, and eventually just knocks it back down. So here's a stock that, you think is having a good morning, but when it's up at 26.5, it's already leaked back almost 2/3 of the gains, which makes you think that the thing could even go flat, or maybe down. So I'm still seller of all rallies here, Abercrombie & Fitch, which I wish I would have been selling it this morning.
All right, 23.85. That's the close, and that was right off the low of the day. All right, Spencer, 8:35, 8:36 actually. Let's bring in our second guest of the day.
All right, Tracey Ryniec from Zacks Investment Research, and we'll be right back with Tracey. Welcome back, everyone. Pre-Market Prep, Spencer Israel, Joel Elconin, and Dennis Dick, now joined by Tracey Ryniec from Zacks Investment Research. Tracey, how's it going on this jobs number Friday?
Pretty good. I'm liking those numbers.
Yeah, and so well, the market was trading up ahead of it, and just have peeled back a little bit, not really going anywhere in particular, but we just want to get to stocks because that's what you do so well there for Zacks Research. And first, how do you make any heads or tails out of the trade and the tariff talks? I mean, they're on again, they're off again. I mean, do you just I was talking about it with Nick in our desk in here, and I'm just I just kind of tuning out. And how do you approach it?
Yeah, that's pretty much what I've been doing. But there are ways to try to seek a little bit of safety on the trade tariff issue if you're concerned about it. And that is maybe to go into some of the small caps, which will have a little bit less exposure to it. I mean, everybody's going to get hit if they start a real trade war with, tariffs going back and forth, because they're already putting it on so many different items that even if you're a small business, you may have some impact. But if you have, the multinational type of corporation with workers in every country type of scenario, you're going to have bigger impacts. So a way to maybe play it is by going into more small companies, or even just more domestic focused, like some of the retailers happen to be, or restaurant chains or things like that.
And I mean, that's evidence. You've had the small caps hitting new all-time highs while the market's just kind of lagging. So, stay away from the big companies that might be affected. It is definitely one way to play it. You're a big bull on energy stocks here. And after this big run in oil here, we're starting to peel back. Give us your thesis on the energy stocks, especially the exploration ones. E&Ps.
Yeah, I love energy right now, but I've been waiting a couple of years, like some other energy bulls, to finally have these types of market conditions where demand is outstripping supply, and the price of crude is going to stay pretty elevated here. Although, as we've seen, as you just mentioned, the price has come back down. Everybody's concerned or worried that Russia and the Saudis are going to pump more to bring down that price, but there's actually no evidence that they are going to start pumping more. Those are just kind of rumors out there that they were going to, and that was enough to bring the price down. But the E&Ps is where you want to be. I mean, the exploration, those companies are directly impacted by the price of crude and also natural gas. So you want to own the ones where they're going to see the most benefit from the rising crude prices. And some people think we'll see $80 at some point this year on WTI, and that is supposedly where the Saudis want it to go so they can IPO their big oil company, Aramco, and also so they can pay for some of the reforms they want to do in their own economy to diversify away from being crude dominated. So if we get, back up into the 70s, all of these E&Ps are budgeting for their drilling and production at around $55 a barrel. So anything above that is great.
How do you know that? Is that information you've come up on your own? Is this something you dig through the company's records? How do you come up with that $55 barrel number?
They always will talk about it on their conference calls. And at the beginning of the year or at the very end of the prior year, they'll give out their production guidance and what they're assuming for their budget, for their CapEx. And they'll say, we're assuming $55 a barrel for 2018, or sometimes they'll give a range, 55 to 60. And then they'll even say anything above that is this much extra cash flow we're going to see coming in. And then we'll decide what to do with that later if that happens. But they've all been pretty conservative on giving their average, budgeting for 2018 because crude hasn't really rebounded like everyone thought it would, or at least not as quickly. So they've had to budget for pretty low, crude levels for several years. A lot of these companies are very lean now. They went to the bare bones in the dark times, and now they're just going to reap the benefits if crude is staying above where they're budgeting. So yeah, I would say with a lot of the small E&Ps, even though the big names are great too, and some of the big names are like Occidental,
Yep.
Pioneer Natural Resources, people know those. But the small guys are really going to benefit from this oil price.
All right, and what are those SM Energy, ticker SM that you mentioned that one? That one's had a nice chart as of late, moved up from 17 to 27 from April. Are we chasing here at $27? Are we going to get a chance in the lower 20s here, or are you still comfortable? Actually, the close was 26.20. You still comfortable in this area?
Yes, I know all of the energy stocks have had big moves, but any kind of pullback, they'll move with the price of oil. So we have seen some of them come off those highs now that crude has come back down under 70. So any of those I feel are buying opportunities in a lot of these small energies. And there's still, if you look at the actual earnings and where that cash flow is coming, they're still actually pretty cheap. So I feel like a lot of these energies are only in maybe the second or third inning of their cyclical run here, and that there's still a lot of upside, which is why I like these small players the best. So yeah, SM Energy, they're based in Denver. They drill in the Permian, and they're also in Texas. Well, the coast of Texas, of course, because the Permian is also down there. But I like some of these small.
What about
small
Devon
guys.
Energy?
So yeah.
What about DVN, Devon Energy? Is that one on your radar?
I don't know that one. No, there is a lot of the small caps that you may have never heard of. So I do encourage everybody to go in and actually check out their fundamentals, because some of them, had some issues financing and with the loans that they have taken out. But if they've survived up till now, I do like it that they're still around. But yeah, I think people really need to kind of drill down, because again, they all know these bigger names, but the smaller ones are the more obscure, and they may only have, 10 rigs or something. So, but that's kind of where the opportunity lies.
What about, we're talking energy here, and TT Mac in the pre-market chat is asking, any thoughts on natural gas here if you're talking about the energy sector? I mean, that has come off its lows, not nearly as impressive as the oil rally. Any thoughts on natural gas or companies related to the production of natural gas?
Yeah, I mean, if you buy an E&P, they're going to have some natural gas, and that is something to look at with the E&Ps. How oily are they? Is it 50% each, or are they drilling more oil out than the nat gas? I'm not as big a fan of the nat gas side, but you're going to get it if you buy the E&Ps. So I'm not really a fan of going into, say, the pipelines or things like that right now. But I mean, nat gas was, lagging there. So if that, for these E&Ps, if nat gas prices start to really rise, then, I mean, again, that's a win-win for them. They both have crude and nat gas rising. So.
All right. someone came out, slapped a $90 price target on Exxon Mobil yesterday, and that's had a nice run up.
Oh.
Is that too big of a stock for you to follow there, or what do you think about?
No.
No. Okay.
No, like the big oils are going to benefit too. And their refining is actually probably pretty strong right now as well. So they have, and Exxon has a great chemical division, and that has boosted them when oil has been down. So I'm a big fan of the big oils, but you're just not going to see as big a rise in the stocks if that's what you're looking for.
Sure.
They're more conservative. They pay the dividend. They did not cut the dividend during the downturn. So you're in it more for a conservative play, but I still do like big oil if you're looking for something that's not going to be as volatile and you're going to get that dividend.
What about SLCA, Silica Holdings Inc.? Nice run up, pull back with oil here. Any thoughts on SLCA?
No, I'm not really familiar with that one. Do they do the sands? Are they in the sand?
Not sure. All right, I got another one for you here. I don't know how about this one? We've had Reverend Emmanuel Lemelson on our show several times. He's made some incredible calls. One that's kind of been a little bit of a thorn in his side here has been Geospace Tech Corp. And this stock just popped over $13 back at $11. Is that a company? And if you haven't done any research on it, I'd sure you'd like you to do some and send me an email, because I've been looking at this thing for a long time and just not had been acting well. You familiar with that one at all?
No. Are they a driller? I don't know that
They're
one.
more of a supplier. So you think, provide,
seismic instruments.
Yeah.
Okay. Yeah. Like on the service side, a lot of these service providers are seeing a real turnaround too in earnings. I haven't looked at this one in particular.
Okay.
They're pretty small, only 150 million market cap. So there are a lot of small players in the services side, but again, there a lot of the E&Ps are drilling more now, and we're at record drilling here in the United States. So a lot of the service providers are also seeing, like I said, the rebound in earnings. So I don't mind the service side either. Anything pretty much energy related should be doing well here in 2018.
All right. We've been on the line with Tracey Ryniec from Zacks Research. Joins our show every few months to give her fundamental outlook on the market, which we need here. We pay too much attention to charts. Tracey, I think I asked you an email. You coming in for a game this year?
I might. Should I? I don't know.
Of course you should.
I'm kind of dubious about the team. I don't know. I should be positive though, right?
Yeah, that means you can't come in and go to Pizza Bob's and a couple other places like that. I mean, all right.
Oh, sure.
All right. Let us know if you're coming in. We'll let you go. Thanks for joining us.
All right. Thanks.
All right.
You almost didn't ask her about Michigan. I was gonna say, wait, you're not gonna ask her about Michigan, but then of course you.
We should have an all Michigan.
No, we should not.
Show.
We should.
What
not.
do you think?
That's a terrible idea.
All blue.
That's a terrible idea.
All dressed in our blue and our blue gear. Even you, Spencer.
No, that's
everybody
right.
Dresses up in blue.
Okay. Let's go to someone that didn't have earnings, but they came out with some guidance, and that was Square.
They did.
Came out with
ASCO. So what were the details there? Fundamentally, Spencer, what do they say?
They are raising their adjusted Q2 sales guidance in light of their acquisition of Weebly. They're raising it from 355 to 360 million to 362 to 367 million is how I'm reading this. They're cutting their EPS outlook by 2 cents, so not a huge deal there. But it raised for the sales outlook for Q2.
I'm looking at the book. This is getting thick. So
really?
59, 190,000 shares. That's huge. So it's not opening over 59. 60. Another 120,000 shares. So there's your two bogeys. Gets through 59, it can make a run to 60, but 59 is a big hurdle because that's a big size. Even in front of 59, there's 33,058.90. So that's, your first level of resistance. Now this thing gets momentum going and start blowing through. So I would say if it can get through 59, then it can see 60. But 59 is going to be a big hurdle for the stock. Now, you come out with some guidance. This thing could chop around a little bit too. So I might even try to play it short in the 80s here off the hop, see how it goes. If it starts to take out 59, then I cover and maybe try to short in front of 60 again. But you're shorting momentum. This thing is looking on the technicals like it wants to break through and shoot through that size, but it's going to take some money to put it through that size.
And what's real interesting here is that you had an all-time high, a former all-time high at 58.46, and it came off hard off that level. And then you teased with it earlier in the week and took with a 58.39 high, and then 58.90 was the high yesterday. We're trading up. I'd say the close at 58.25. I'd just be careful if you do take out all that size at 60 and it doesn't go like 05 bid, 10 bid, 15 bid, then you just may have a lot of people, choking on that size. One thing I wanted to mention.
It's a tractor beam play, which we haven't talked about for a while.
Why don't you talk about it?
When you have size, so I coined this one, I call it the tractor beam play. When you get close enough to a level where you have and I've got actually a presentation. You can just Google like Dennis Dick tractor beam, and I got a full presentation somewhere on the internet on this. But let's say this 59 level, for instance, because it's 190,000 shares. As you get, into the 80s and into the 90s, and you approach it, it actually kind of sucks the price up into the 59. And the reason for that is the basic market making mechanics, because you got people leaning on it. So they're selling it short, and then they're putting out, scalping orders. They're putting bids to buy it. So as they sell short in like 95, 96, they're putting bids out in 90, 91. What that does is thicken up the buy side of it. And actually, as more and more people lean on it, it can actually push the stock price up into the size to eventually take it out. Once it takes it out, one of two things happens. Either if it takes it out in one mighty blow, like 190,000 shares just goes boom, somebody says, I'm buying them all. Then it catches everybody who is short, and you see this huge whipsaw where it just spikes through the price because everybody who is leaning on that for short missed their lean. So they can't cover it now because the 59 is gone. So they're trying to scramble for cover. They're looking at 59.10, 59.20, maybe 59.25. So it spikes up like 20, 30 cents in a hurry, just because it all went in one blow. If it pecks it away, like slowly goes through it, then you catch people who are like banking for the immediate breakout, and there's too many people that get long the thing and it actually spikes down. So all the mechanics behind the size are on how quick the print goes. You won't read that in a textbook, but I can tell you this kind of stuff works. So it's on how quickly that print goes. It goes in one shot, the thing usually spikes through it and then can continue to run. If it goes and pecks slowly away at it, too many short-term day traders playing it for a breakout, and the stock can actually go the other way.
Dennis, great illustration of this yesterday, and I bet we'll talk about it with Brent yesterday. Guess what the new all-time high in Microsoft is?
99, 99, 99, I think, or something.
Exactly.
Even the sub pennies, Joel.
Yes.
Even the sub pennies coming into play there. So, and what is that? Why is that? Because it's huge size at the point, and it couldn't take it out. So again, these big psychological levels aren't just psychological. There's institutional size sitting there selling $100. It didn't have the gas to get through it. Sometimes comes back up, and I always say, it comes out at once. Usually it may not be able to do it the first time. Comes out the second time, it sometimes is a gas. Usually third time, it always takes it out, because no such thing as a triple top. And I always say third time's a charm. So if it comes out at once, it already has now. Comes out it again, it might take it out. Comes out a third time, it's taking it out.
And also just how much it has to run to get there. Like today, it need to be up 86 cents. So if it's a real strong day, it's going to, have a buck move. I don't know what the average daily range is, but just to go in a little bit deeper about what Dennis is talking about, institutional traders and traders on desk around the world have so many orders at $100 that, they know that they basically have a penny or less a penny loss if they have to fill those orders.
The traders that are leaning on that institutional
leaning on those institutional orders. And so they basically are risking a penny or less with a free look on the downside. I mean, you talk about a risk reward ratio. I mean, yeah, sometimes they do get caught. Sometimes they have to flip those orders, but they're risking a penny. Microsoft closed at 99. Well, it's up 30 cents. It closed under $99 yesterday. So, great.
They make a buck on that
if
you played it out.
If you could do it, if you're comfortable. Spinner's talking about Costco at 200.
just want to continue the conversation, just because sometimes it's fun to talk a little education, and obviously we've got lots of earning stocks, and sometimes it's just fun to just educate a little further. So just take that one step farther. So, you've got that huge size at 100. And what Joel is just to basically explain what he's saying is back in the day when we first started trading, Joel, and, you started on the floor in 87, but when we were trading the Braid office in like 99, 2000, 2001, it was all trading in between the institutional orders. So you saw institutional orders on the book, and that kind of acts like a roadblock. So there's a big seller here, a big buyer here, and the stock would just chop around in between that big buyer and seller for a prolonged period of time. And as a day trader, you would trade that range then because you're trading in between the size. So now, it's a little bit of a different game where institutions, for the most part, hide their size. Although you get sometimes, people who are just posting it, like I just said on Square. So it's still the same game. It's just been sped up. So most of the time, it's high frequency traders doing it now, and they're leaning on the size in the same way. So when that size goes, they're quick to get the hell out. It's hard for a manual trader because the algorithm and the high frequency trader can grab the size so fast that the human trader can't grab it quick enough. So the human trader often gets caught on these things, but the machines don't. So the same game is still being played in between all the institutional size. It's just the machines playing it. But if you can predict how the machines are going to play, how the machines are going to react, you used to say this, Joel, they lean on the size, so if the machines are leaning on the size, we'll lean on the machines because we know the machines are going to be littered up in the 90s. So maybe this thing tops out in the 80s. So for Square, for instance, I've actually just been starting to accumulate a short position in the pre-market in the 80s, saying I don't think it can get up into the 90s. Now, if it does, that's a different story. And it starts going 95, 97, then it's looking like it's going to take it out. But that's a different way to play it, so you can still make money playing the lean game. It's difficult to play leaning on the actual size that you see there in the after hours of that you see during in the regular session there, the 59 we're talking about, because you could miss it where the machines won't miss it.
Dennis, I am putting your tractor beam article in the chat that you did for the
CFA magazine.
Yeah, CFA magazine. DM Childs, how many shares you need to be bought or sold at support resistance levels? That's kind of a lot.
In this case with the Square, it's 190,000 shares. I can see that order in the book. These orders are rarely fake when they're showing that kind of size, especially in the pre-market. That's why I love looking at the book in the pre-market, because the stuff you're seeing is usually real. You don't have the high frequency envelope stuff going on yet in the pre-market. So these books that are on the orders on the book are usually real. So if you add that up, 190,000 shares times 59 bucks, what is that? 60 bucks times, say it's 200,000 shares. What are you talking about? Like, I can't even do that quick air math, Joel.
More than that, right? I can't even do
that. 1.2 mil?
100,000
of yeah. Are we doing that math right? Quick, we suck at math now. It's all it's the calculator.
12 million.
$12 million.
That's what I said.
So 59 times 160. Yeah. So you're right. So 59 times 100 and it's 200. Say it's 200,000 shares. So yeah. So 200,000 shares times. I'm using the calculator to check Joel's math. It's $12 million. It takes a $12 million worth of buyers to take it through 59. That's a lot of money.
All right.
That's like either one huge institution or a lot of smaller institutions to take it out. So that's why these things act like roadblocks. It's not, rocket science. It's simple math. It takes a lot of money to take it through 59. It's going to take a $12 million worth of buyers to take it through 59 here today.
Okay. All right.
That's going to be tough.
I wanted to show one, since what we're doing is talking education today here. I figured we'd wrap with some education here. And Dennis, man, what a print in XBI yesterday. Just talk about that. I know you didn't get a piece of it. We got about a minute. Let's just talk about the market imbalances and being on the guard. But talk about that print in XBI.
And this is just talking about order flow stuff there too. And if you look at XBI and you look at the close and you say, what happened here? So the stock is happily trading at like 950 or 359 right before the close at 95.50. All, Arbs are all happy, 95.55, 95.60, right in that range. Boom, gaps down on the closing print to 94.67. What was that? Well, there's a huge sell order on the books, and you can show, can you see it? Joel's trying to actually show you the print there. So if you can blow it up a little bit bigger, maybe, Joel, you can actually see the print down. But it was 181,000 shares were to sell in the close. And that's knocked the XBI, the ETF, down 90 cents on the close. So anybody who had an order out there sitting on the books on ARCA, at 95, 95, 10, 95, 20. Would have got filled at the 94.67 closing price, could immediately sell it in the after hours because it was a 95.5, 95.60 bid, because that's where the arbitrage value is. So it was just free money if you had an order out there. I like free money. I didn't notice this one. I didn't participate on it. A couple of our traders at Bright Trading did, because they notice this kind of stuff. They have algorithms to take advantage of this kind of stuff, and they were actually able to buy it at 94.67 and quickly flip it out. So this is, just the game that sometimes, and it's not even a game, this is just a way to take advantage of some institution that put too big of an order on the books and the market couldn't shoot up.
All right, let's wrap things up here. S&Ps are trading up 1675. It's 27.22. We're even going higher, up 17 even at 22.75. A little bit of a pullback there, but you could just feel the bids coming in. Yesterday's high is my target here for some early longs at 27.28 and a quarter. The high of the move, 27.41.75. Well, Dennis, we need to get to cover a whole lot of stocks today, but hopefully you guys found this information useful for your intraday trading, your long-term investing.
There is one more thing that I do want to highlight just real quickly.
Sure.
Today is the start of the ASCO conference, so the American Society of Clinical Oncologists, biggest cancer conference of the year. It starts today, goes, I want to say, through Tuesday, though don't quote me on that. A lot of biotechs are going to be coming out with headlines. If you follow that space at all, pay attention to stocks like LOXO, Novartis, Gilead, Bluebird Bio, Celgene, Bristol Myers. You want to pay attention to all these stocks. Merck, of course, Nectar Therapeutics, NKTR, EXEL is one. There's just a lot of stocks that are going to be, or companies that are going to be giving explanations of data and their drugs that will very likely move off of comments made at this conference. So again, that's the American Society. ASCO is the name of the conference. ASCO 2018. That'll be starts today, and will definitely cause some volatility in the biotech and drug market if that is your bag. But that's going to be it for our shows this week, guys. Hope you enjoyed both our guests, Tracey and Ryan. Thank you, Joel and Dennis, for that very nice segment just now on order flow and kind of how that works. We're gonna be back on Monday, I guess, right? That's gonna be that's it for us today. So we'll be back on Monday, and hope everyone has a good weekend and have a good one.